Yes, sir. Let's start from what does, as per you, Akhil, since you've seen the journey of Airtel very closely in terms of various capital structures, what does a capital structure stack for you look like as equity or debt? Is it fungible? How do you see it? Because what I have realized in the journey is right, and what I felt excited 7, 8 years back was a lot of people, at least in new age businesses, never understood the use cases.
Yeah.
So how would you define for debt as an asset class and under the broader capital structure of what you see?
Well, thank you very much for a very lovely introduction, Shpreet. I think fundamentally, if you look at a long term basis, every company has got to have and should have a very nice balance between equity and debt. A company without debt is not good. Conversely, too much leverage, so many cases where the companies are falling flat because of too much leverage. So it's a nice, fine balance. And if you understand it right from the beginning, it's better. So in the beginning, and I'm talking from Bharti experience, at the very early stage, we had to resort to equity because without that equity, nobody was willing to give us debt. But the moment we got equity, the first thing we did was project finance. Of course, we didn't have private credit and all this stuff then, but we had IDBI and IDFC and ICICI. So we always tried to maintain that balance. Initially, because we didn't have profits, no EBITDA, so it was debt to equity ratio. And obviously, as we went along, we were extremely conscious about net debt to EBITDA. That is something we followed very religiously. We never let it go beyond 3.5, never let it come below 1.5. So the moment it would come down below 1.5, I think your business is crying out for more debt and more growth opportunities.
So that's such a conflicting stance from a perspective of what I've seen with startups, okay? Because we come from that perspective, typical Indian families where debt is sometimes perceived negative, the connotation itself they don't relate. Udhar is the first thought comes into the mind in terms of Indian connotation. So that perception of saying no, 1.5x is bare minimum, it has to be 3x. How does that sink in? Because these new age companies, right, you have to sometimes really explain over a period of time. And they get it now. That's why you see the growth. They're getting it over there. But how do you change that connotation that you were so sure as the first CFO, as co-founder of Bharti, trying to build this from a perspective of ensuring that debt is an equivalent part of equity as a capital stack?
I think today's startup ecosystem is very different from what we guys had when we started. In our time, even a startup was an absolutely solid business with a revenue model, with a very clear path to profitability. Today, quite a bit has changed. I think that path to profitability is allowed to be very long today. We didn't have that luxury. Talking of the families, I think many of these youngsters have just debunked all those theories. They are aggressive, they are risk takers, they don't mind betting their last shirt. So I think that thing about no debt, no external capital, that's all gone. Today, what I do see, and I do, like you mentioned, advise quite a few of these new age entrepreneurs. I think it's a matter a bit of mentoring and advising. That debt is not a bad thing, but you have to have it in balance.
Yeah,
You should have some debt.
When you require equity, you require equity
Yeah.
for the business. And in the same breath, okay, you've not only have done domestic debt, you've done international debt, and that we recently funded a company, Mobi, which did international structure. There are a lot of opportunities like Indian companies are going global, and that's an important part of our deployment. How do you see that? How a company have first of all a thought of being global and access debt, project finance, and those kind of avenues which are available internationally. Very few people are aware about it, but they have not explored as much.
So let me put it in two parts. For our Indian business, I was never in favor of a dollar debt or any foreign exchange debt. Because one thing was clear, the Indian rupee was destined to depreciate 3 to 4% per year,
Which has been happening.
which has been happening. And if you look at last 40 years, it has been happening. And technically also, that was bound to happen. Therefore, the foreign debt was always something I never liked, but having said that, we did resort to it. Because so much of Indian money was just not available in debt at that time. So, for instance, we had a lot of imported equipment from Ericsson, Nokia, Motorola, and so on. So that always came with the ECAs. That's one thing which obviously companies should resort to. But other than that, today, if you have revenue in rupees, try to keep your funding in rupees. Like I always tell, particularly the startup, this is what separates men from boys. And I'm actually very pleased to tell you that 2 or 3, actually every startup I have been associated with, they have all moved to quarterly audits. Zepto is on quarterly audits. Snapdeal, Spinny, each one is on quarterly audits now. So it's we talk a lot about governance. That's a very fuzzy-duddy kind of stuff, like ESG, right? The other parts of ESG also.
Yeah.
But if you really want governance, you have to be very transparent. That's why even today, when I see a company which is struggling to give financials for the year ended on 31st March 25 or up to 31st December 25, I wonder what's going on. If you can't have your financials right, what else will you cover?
And similar in the, since there are a lot of companies, Indian companies want to go global, you acquired a lot of global companies.
Yeah.
What kind of things went behind? Because there's a lot of ambition for Indian companies to go global. We are a global company. What things to take care of while doing that? And what are the things which worked in your favor while doing those acquisitions?
Well, we went through, in 2010, we acquired operations of Zen. This was in 15 countries.
Zen itself was in 15 countries.
Yeah, so we acquired running operations. And obviously 2-3 things, this was telecom, so the business was known to us. So nothing very different, but yeah, some regulatory differences and so on, but no big deal. Telecom has fairly common regulation everywhere. So I think when you acquire something, you just need to have a good due diligence. Just need to make sure that whatever is being presented is the correct picture. And rest is your capital structure.
Do you want to mention a bit about capital structure? How do you innovate there?
Well, like we acquired Zan for $10.6 billion. That was the biggest deal out of India, and the entire funding was done by debt. We didn't have again private credit, but we had
Is it a part of the report of ours?
the Dada Bank like stand chart. And my condition to them was that I'm not going to go in the market to raise these funds because I need to close the deal as that. So if you want to be associated, the actual check size was $9 billion.
Yeah.
So you write the check for $9 billion and then go and raise it later.
Yes. Since we have done a lot of acquisition finance, I think very few people understand the ROCE of doing an acquisition finance. Because not only you're buying targeted through leverage and you have a better entry point, the value creation which you're doing in your business while adding up over a period of time and the cost you have paid is a real ROCE for these acquisitions.
Yeah, I mean, that goes for every business because ultimately, EBITDAs, margins, all these have no meaning.
Yeah.
The ultimate thing is ROC. That's all what one has to look for.
Yes, so if you just in the same breath want to differentiate between what you see, since you mentioned a bit that today's startups are slightly different, quarterly statements we have not seen. What else do you see in these companies which are different than some of the traditional companies because they had been startups themselves? Anything specifically you want to highlight beside, and you are very particular about one thing. I remember I met you for the first time as tried and you're talking about certain things. And I said, when you're listing, I
Yeah.
said, okay, why do I want to list? So you said that there were certain points which you might want to bring it up for the larger
Yeah.
audience.
Yeah.
So if you want to combine both the questions.
I think the problem I find in most of the startups today, these are all entrepreneurs who are very revenue oriented or let's say customer oriented. They want more and more customers, expand very quickly, but are not really well trained on the financial aspect. And that's why this governance bit doesn't come very naturally to them. And so they need support on that front. And those who understand the importance will obviously do very well. Now, coming to the IPO, yes, that's my favorite. I do personally believe one should not even try to get into any business unless you want it to be listed one day. And the reason is very simple. If you get into business, your aim should be to create an institution. You can't be making a business and saying, History Junior will run it tomorrow. He may give you a kick and say, I'm not interested in that. I want to do painting. You can't build it for your family. You have to build an institution. Second, I think IPOs or the listing brings a whole lot of accountability. People who say, oh, I'll be under scrutiny, they are wrong people to run business. If you can't be under scrutiny, you're not meant to do business.
And about the liquidity element which you mentioned.
Of course, you don't have to run after anybody for funding once you're listed. You always have the option. Because one thing which you ought to realize, in every country, it is only the central bank which has the currency or the power to issue currency. Listing is the only other thing which gives you currency.
Yeah, that was unique.
You can actually use this currency for acquisitions. And my experience is, many a time, the entrepreneurs who want to sell don't want to completely go out of that system. They don't want entire cash. They would be very happy to take part of the consideration in shares. So it works extremely well. This currency is priceless, very important.
So congratulations on our common portfolio companies Zepto filing for June IPO. And let's look forward to it. Last question, Akhil, and we want you to discuss this because there's a perception about US private credit.
Yeah,
Let's speak about it candidly. What do you think and what we think? And we have as many clarifications for at least the audience who are confused about private credit.
well, first of all, a disclaimer. I told Ishpreet that I'm not the right person because I'm definitely not an expert as yet on private credit. I'll have to learn a lot from him. There's been so much of noise in, I would say, the last 2 months, 3 months on private credit, particularly from US, where big names had to stop redemptions or control redemptions. And it made me wonder, what the hell is going on? Private credit, by very nature, is not a liquid asset. It can never be. How can you possibly treat a private credit fund like a mutual fund and allow people to get in and get out? Because the asset liability mismatch is tremendous. So I don't know why these funds became mutual funds. I've not been able to understand it. But other than that, in terms of defaults, I don't think there's any serious concern.
No, you've been kind enough, but you know the global markets well, in fact, very well. Look, I think the difference which we spoke about being the close-ended funds and open-ended funds. Good thing about us in our infrastructure, we're all close-ended funds. And
Yeah.
US allows that option of being an open-ended fund, which means that you can enter and exit any point of time, which is what your mutual fund concept is. At the same time, the economies are very different, right? While they have allowed open-ended funds, they have also allowed a lot of leverage, light financial covenants, and all of that is a very by nature of the economy, right? Which has been quite progressive around credit. So I think the economies are very different, the shapes are very different, the regulations are very different. So apples oranges in terms of comparison. But at the same time, I think India has that opportunity to be slightly more evolved on private credit because a lot of structures which will come in, which has been prevalent internationally.
Yeah, I think one thing which comes to my mind, there could be scope for many secondary funds which could actually work as market makers for these private credit funds.
Already 5-6
Okay.
relevant secondaries fund. They are gaining size and momentum. There will be further things as well. There will be GP financing product, which is very prevalent in Europe, US, which should be introduced in India. But under the regulations, whatever you can do with AIFs, right? There can be innovation around the products. Acquisition finance internationally can pick up.
Right.
So yeah, that's about it, guys. I think the intent was to learn from the person who himself used finance brilliantly over a period of time with Bharti, and what he's now doing with some of the well-known startups in the ecosystem.